Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at oil, everything oil related. Oil is looking absolutely fantastic. It's looking fantastic, guys. Some of the companies look really good. And I know some of the companies have had pretty big runs, but I still think that they are undervalued in relationship to the price move of oil. So there's a lot of upside that is in these stocks still, and I still think they're very good investments. I still think they are. Are they better than uranium? Probably not. At this time, uranium looks really good. But the undervaluation of some of these companies, I would still put some money into some of them, yes. And I still think they're going to outperform. I can touch on some of these of the outperformance and some of the patterns that I see to align with the potential outperformance here. So let's take a look. I'll show you what I've got. Again, it's just my financial opinion. I grabbed a lot of this information off Twitter. So let's take a look at what I've got. So up here is the 2023 enterprise value to cash flow at $100. And it should be 2022 that he put in here. Usually they trade between a 4 to 6 target multiple, and some of them are kind of getting in there. But some of these, like Athabasca Oil, NVA, which is New Vista, I think, these are really cheap. We got Crescent Point, Baytex Energy, Vermilion, Ovintiv is OVV. There's our Surge Energy, Callan Petroleum. Their CDEV is only at 2.2. These are still very undervalued in relationship to what they've traded historically. So you could see, I'll just call it at a kind of a 2 cash flow in here. These could easily double to triple to get into this target multiple without oil going up from $100 a barrel. If oil starts going up, if oil doubles or triples, you've got a double to triple on the double to triple. So you still have a whole bunch of upside left in oil, especially these companies that are on the left-hand side that he's charting out here. Another one, the US Big Three, the crude, gasoline, and distillate inventory deficit. We are still going down into large deficits. And you can't fix this with a release of inventory. We're just going to continue to eat through those inventories. You can't hold prices down either because you need demand destruction. If you hold the prices down, you don't destroy the demand, you just eat through all the inventory. So kind of in a conundrum here. We need higher oil prices to destroy the demand to balance the market. And that's what we're seeing. Oil, it seems like it can't go much lower from where it's at today, even with inventory releases of the Strategic Petroleum Reserve and the International Energy Agency Reserve. So I mean, I'm in the camp. I'm a bull. I'm a bull. I'm not a perma bull, but I'm a bull based off of the inventory and the deficits that we're running. Looking at some other stuff. How do you allocate unexpected free cash flow? These are questions that were asked to oil companies and natural gas companies. And the majority of these, we want to look to see where the majority have answered. So CapEx, they're going to have a slight increase in CapEx. They're going to be unchanged on acquisitions. So they're not really going to be, I think, acquiring too much in mergers. The debt reduction, they're going to increase debt reduction. They're going to have unchanged special dividends of whatever they have. They're going to have unchanged dividends here and then share buybacks. It looks like they want to deploy the money into share buybacks, not so much into CapEx, only a slight increase. They're not dumping it all into their operations to increase. They're actually giving it back to shareholders and investors and buying back their shares to raise their earnings per share, to raise the stock price. It says, how do you rate the following reasons on why producers are holding back on growth? Investor perception for maintaining capital discipline is a key factor. There's a slight factor in the lack of rigs and qualified staffing. Reallocation of cash flow to dividends and debt is a key factor and important. And then you've got some other smaller stuff down there in terms of government regulations and lack of external capital. Looking at this, I don't know what this is still. This is from April 4th, but Kathy Wood still thinks that oil is going to go down to $12 a barrel. This supply and price shock is destroying demand and accelerating the shift to electric transportation. What I'm seeing in the minerals, in the shortages of minerals, I think that this is going to be very difficult in the shortage of minerals across a wide array of commodities things like aluminum, zinc, copper, rare earth metals, lithium, graphite. I mean, you can go on and on. So I don't think this is going to happen. And I don't think this is going back to 12. I don't know how. That's below the cost of almost all the producers. So, I mean, it could temporarily spike down there, but I don't think it could stay there. And she's saying it's going to stay there. The largest SPR release announced in history, and oil is still $100 West Texas Intermediate. Why? The quantum of the energy crisis cannot be solved with supply alone, especially now with Russian exports unthinkable to the civilized world. Demand destruction is the answer via meaningfully higher prices. I agree. It's just the market trying to find a balance. And if we interject, we'll call it external powers on Russian exports and put sanctions or whatever else, it's just going to make the problem worse. But I do think this oil is going to get into the market. I do think that we are going to still use it. And I don't know what the negative, I put this in here. There's a lot of negative, a negative outlook against the oil companies. I don't know why. It says, here's a thought. If the oil companies won't reduce their prices, how about they pay for free parking at every hospital for everyone? This would help staff and patients and maybe tax deductible. I don't know how that solves anything. I hear this a lot about like price gouging and how the oil companies are making all this money. It's like, yeah, but they didn't make money for a very long time. And when they don't make money, nobody cares. When they go bankrupt, nobody cares. But when they make a lot of money and it's their time to shine, everybody hates them. I don't understand this outlook. They must not understand the markets. That's my guess. Here's Stanbury. It says, on Monday, crude oil prices jumped higher amid Western sanctions and the Russian-Ukraine conflict. Russia produced around 10.1 million barrels per day in 2020, about 10% of the annual global consumption. That's a big chunk that we're putting sanctions on. We've got here, actually, let me go back up. I already covered that. We've got key sanctions, coal and oil imports. UK to end all dependency by end of 2022. I'd like to see how that works out for them. Very interested there. We've got oil prices. In addition to releasing the U.S. oil reserves so U.S. corps can cut their production, Biden says we should buy an electric car. Sure, now $50,000 with rates 5+%. After our real wage income is collapsing due to 10 to 15% inflation, that will continue all 2022 and into 2023. That's a fair statement. Your buying power is going down. The price of electric vehicles are going up. And then we have higher interest rates to finance that if you're going to finance the purchase. I'm not going to be buying a electric vehicle. I'm just going to drive less if it gets to that dire situation. It says crude prices fall as COVID lockdowns curb Chinese crude demand. Another thing in the background that's happening is people are a little bit afraid of the Chinese crude demand. Here's the problem, though. We can have these headlines, but what I look at is this. This is your inventory. We are still declining and running deficits in inventory. That lockdown has not had a material impact on inventories. That's all I'm going to say. If the U.S. goes through releasing 180 million barrel release of crude, that'll amount to nearly 1/3 of the nation's strategic petroleum reserve. And we've got this reserve going down. We are just eating through other inventories at this point. They're trying to hide it. They're just shifting inventories around saying, hey, look, we can shift this around. Hopefully prices go down. But it's not going to solve the problem. The problem is that we're running deficits and we need to destroy demand if the supply is not reacting. It's that simple. Oil tumbles after IEA calls for emergency stockpile release. Stock market losses further put strain on global economies, but hopefully provide some temporary relief for consumers at the pumps. Yeah, they're just shifting stockpiles and inventories around. Josh says, rig count rising, production isn't. Oil rig count's up 13 rigs, gas rig is up 141, and the rig count's going higher, but production is not. I shared my thoughts on the oil gas bull market and where I'm finding opportunities on the recent Macro Hive podcast. I was on our podcast show this week to talk about $200 oil and the structural energy supply problem. So he talks about $200 oil and the structural supply problem. I've got the commodity bull market here. We've been moving on up in this channel here. We were at the bottom of the channel in I think this was probably 2020. It's got to be 2020. And we're moving on up. We've got a big move here. We might come all the way up past this top of the bull market. We'll see. I think that we're going to probably see a very large move. Now, here's the thing. All right. We talk about cylinder patterns. So we talk about these patterns. We have a basing pattern here, and we went off the gold standard. The Fed went into power in 1913. That was back in here. Fed went into power and is becoming all, we'll call it unstable. It was going sideways. Now we're on an uptrend. That's just inflation. And this could be a lead-in. It's usually 1, 2, 3, 4, 5, 6, and then the blow-off top. This could be the Livermore barrel pattern playing out, where we just launch higher, way higher to the upside for commodities. It's not a prediction. I'm just saying that's a possibility. It's a possibility where this thing just blows way up to the upside. And we're also seeing that with the inflation. If the inflation blows to the upside, this will also blow to the upside. This is the US stock market performance by PE ratio in the 1970s. So looking backward at 1970, this is where the commodity complex would have been a purchase, was in 1970. We want to be in the cheapest low PE because value is going to outperform growth. And you could see that value outperform growth during that time period by a pretty large margin from late 1969 all the way to 1980 roughly. So cheapest PE is the lowest PE quantile did very well, and then the second lowest quantile did well. So what this is showing us is that the lower the PE companies, which is usually commodity companies at this time, like shipping is really low right now, oil's low, and all those others, those are the ones that are going to outperform over, say, the high PE. And this was in an increasing interest rate environment. And I think that's what's coming for us, is an increasing interest rate environment. Here's the cycles of U.S. equity outperformance, just to show you the cycles, the EAFE outperformance, and then the U.S. outperformance. And you can see that the U.S., they basically go back and forth. What this is the real estate cycle for the most part. It's all the real estate cycle. The real estate cycle, the AEFE, which is an international type investment, is what you want to be. And then the U.S. stock market performs during the we've got the recovery phase. It outperforms during the recovery phase of a real estate cycle. Looking at this is the March 2022 OPEC production versus quota. They were underproducing by 3% in total, but now it's minus 10%. This is total OPEC plus. This is rest of OPEC plus. So the rest of OPEC is declining in production versus the quota. So we've got some problems. We are not hitting quotas, and I don't know if they can. Now here's something that says the energy crisis. Europe's energy conundrum. U.S. and European energy spend as spiking as percent of GDP, inevitable consequence of underinvestment in reliable energy sources and over-reliance on renewables. Here's EU, 9.1%. This is the energy burden as a share of GDP. The more that people put in renewables, the higher the percent of their energy costs are in relationship to GDP. And I think US is going to go up as well. And these solutions, the renewables, are supposed to lower the price of energy, but they're not. They're doing the exact opposite. They're putting more reliance on fossil fuels, and then we're eating through all our inventories. So we are in dire situation for a need to store electricity. And I think that storage will be hydrogen because it's the easiest solution. You can't dig up a bunch of metals in an energy crisis. When you're short energy, you're not going to be going in an exponential mining boom. I think we're going to have to go to a solution that is easy to store. And hydrogen seems that way, and we can also use hydrogen as a way to power and fuel large, we'll call it large, like semi-trucks and airplanes and shipping and all sorts of stuff, and reduce emissions. But the reducing emissions, I think, is going to be irrelevant when we have energy shortages. I think that's the way that I view it. Now, here's something that's real interesting. It says inflow to equities exceeds combined inflow of past 19 years. So we have this massive inflow to equities, all that money printing and all that stuff that came up. Now, here's the thing. What if this turns into outflows as this goes back down? What that means is we have a record amount of money that's going to be outflowing out of equities into commodities, which is going to blow up the commodity complex in terms of pricing. So I think that looking forward, we've got the conditions here where money is going to, I think, interest rates are going to force money out of equities, and we have a record amount of money in equities. That money is going to go outflow, and it's going to go be a record amount of money flowing into commodities. That'll be next. This is another one. It says oil inventory draw net of SPR release. It will be interesting to see how oil inventories progress as summer approaches. Bullish decline in gasoline inventories is nice to see too. So when you look at this, you've got crude oil, it's up 2.4, but all they did was release it from the Strategic Petroleum Reserve. And the deficit is this difference. So it's a 1.3 million deficit that we took, and they're just shifting inventories around, basically doing an accounting, just accounting for it differently. They're saying, oh, we've got, a build over here, but you basically draw it from the Strategic Petroleum Reserve. The Cushing is up 1.7. That's up a little bit. Gasoline's down 2 million, and distillates is barely up. Refinery utilization is 93% or so, and that's what we've got for there. So I think that's all I've got for for this. That's the most recent information that I've seen on Twitter for oil. I am a huge oil bull, guys. This is not going to fix itself without higher prices, in my opinion, and it could be substantially higher prices. So, oil's looking absolutely excellent. That's what all the data is showing, and it's still a very good area for investment. Very good area for investment. So that's what I've got for today. Give me a thumbs up. Subscribe to the channel if you haven't already. Look at my website if you're interested in joining the website. Do a platinum membership. Hit those question and answer sessions on the weekend, and that's where I would be. What I would be doing if I was a new investor is I would learn from someone who's already gone through all this stuff, is presenting information on what is going to be the best performing sectors, companies, areas. You can look at my older videos. Everything's documented of my performance and my picks, and that's what I've got. It's all out there. You can see everything I've got. So if you're wondering what my performance is, last year, I think it was last year, I was up over 300%. It was mainly driven by oil outperformance, and I had a large uranium stake. This year, I don't know what the exact is. I didn't actually look. It's up a lot. I'm up a lot in terms of a year-to-date performance. I'm overweight oil still, and I've added a lot into uranium. I do own precious metals, and precious metals, I think, will outperform here too. So you're going to see a big outperformance. Now, I wasn't up 300% in every single portfolio that was on my energy portfolio. There were some portfolios that were only up 100%. It seems like a lot, and it is a lot. That was the ones that had more diversified mining in it, and more of the precious metals, because the precious metals haven't taken off yet. The sector that I would probably overweight right now is uranium. That's the one I would be looking at. All right, guys, we'll catch you later. This is Finding Value.